Credit cards feel so normal today that most people never stop to question where they came from, who designed them, or why they spread so fast. We are told they exist for convenience, safety, and freedom. Yet beneath that comforting story hides a darker truth. Credit cards did not simply appear to help consumers. They were carefully shaped by crises, power struggles, and profit motives that quietly rewired how Americans think about money. The mystery is not why credit cards exist, but why their real history is rarely discussed. Welcome to Meta Economy Lab, where you can learn and understand more about the economy and related topics, so you can subscribe to the channel for continuous learning. To understand the dark history of American credit cards, we have to go back to a time when borrowing money carried shame. In early America, debt was seen as a moral failure. If you could not pay what you owed, you faced public humiliation, jail, or social exile. Cash ruled daily life, and credit was personal, local, and risky. Banks existed, but they served merchants and landowners, not everyday families. The first cracks in this system appeared during the Industrial Revolution. As factories grew and cities expanded, workers began earning regular wages instead of living off farms. Companies needed consumers to buy mass-produced goods, but wages did not always arrive when bills were due. Installment plans emerged quietly, allowing people to pay later for furniture, sewing machines, and appliances. This was the first shift from saving before buying to buying before saving. By the early 1900s, department stores began issuing store credit cards. These were not plastic yet, but paper charge cards tied customers to a single store. The goal was simple and powerful. If shoppers could delay payment, they would spend more. Store owners discovered that credit did not just increase sales, it changed behavior. People bought things they never would have paid cash for. The Great Depression should have killed consumer credit, but instead it reshaped it. Banks collapsed, unemployment soared, and trust in financial institutions vanished. To survive, businesses needed loyal customers more than ever. Credit became a tool not just for profit, but for survival. Quietly, lending shifted from moral judgment to calculated risk. World War II temporarily paused consumer credit growth as rationing limited spending. But the real explosion came after the war ended. Millions of soldiers returned home, started families, and moved into newly built suburbs. America entered an era of optimism, consumption, and mass marketing. Credit cards fit perfectly into this new lifestyle of abundance and speed. In 1950, Diners Club launched the first modern charge card. It was not meant for ordinary people at first. It targeted businessmen who traveled and entertained clients. The idea was revolutionary. One card could replace cash and bills across many locations. What few noticed was that this also centralized control. One company now tracked where you spent, how often, and how much. Banks watched closely and realized something even more powerful. If customers did not pay the full balance each month, interest could generate endless profit. Bank of America launched Bank AmeriCard in 1958, sending unsolicited cards to thousands of Californians. Many recipients never asked for credit, yet suddenly they had it. Defaults were high. Chaos followed, but the long-term experiment worked. This was a turning point. Credit was no longer something you applied for carefully. It was pushed into households. The idea of borrowing became normal, then encouraged. Over time, shame faded, and convenience took its place. Advertising framed credit cards as symbols of trust, success, and adulthood. By the 1970s, inflation and economic instability hit American families hard. Wages struggled to keep up with rising costs. Credit cards quietly filled the gap. Instead of demanding higher pay, households borrowed to maintain their lifestyle. This shift mattered deeply. Debt became a private solution to public economic problems. A major hidden change happened in 1978 with a Supreme Court decision called Marquette National Bank v. First of Omaha. This ruling allowed banks to charge interest rates based on their home state, not the customer's state. Suddenly, banks moved to states with loose regulations. Interest rate caps vanished. The modern high-interest credit card was born. This legal shift unleashed aggressive lending. Credit card companies flooded mailboxes with offers. Teaser rates hid long-term costs. Fine print grew longer while ads grew friendlier. Many Americans did not understand compound interest, penalty fees, or variable rates. By the time they did, balances had already grown. During the 1980s and 1990s, credit cards became essential to daily life. Renting cars, booking hotels, and even building credit scores required them. Opting out was no longer easy. Credit cards stopped being optional and became infrastructure. This dependence gave banks enormous power over consumers. One uncomfortable truth is how credit cards targeted vulnerability. Students, low-income workers, and minorities were often offered cards with higher rates and lower limits. These customers generated the most profit because they carried balances longer. What looked like inclusion often masked exploitation. The rise of credit scoring deepened this system. Your credit card behavior began shaping your financial future. Missed payments followed you for years. Interest rates adjusted not just to the economy, but to your mistakes. A single emergency could trigger a downward spiral that felt impossible to escape. By the early 2000s, credit card debt quietly reached historic levels. Families used cards for groceries, medical bills, and gas. This was no longer luxury spending. It was survival spending. Banks reported record profits, while households reported record stress. The 2008 financial crisis exposed cracks in the system. But credit cards survived almost untouched. While mortgages collapsed, credit card interest rates often increased. Bailouts stabilized banks, not borrowers. Many Americans learned the hard way that credit cards offered flexibility without forgiveness. After the crisis, regulations improved disclosures, but not incentives. Credit card companies adapted quickly. Rewards programs distracted from interest costs. Points, miles, and cashback softened the psychological pain of debt. People focused on earning rewards while losing far more in interest. Technology made things worse and better at the same time. Apps made payments easier, but also made spending frictionless. One tap replaced counting cash. The pain of paying disappeared, while balances grew quietly in the background. Today, credit cards sit at the center of American economic life. They track behavior, shape credit access, and influence mental health. They are sold as tools of freedom, yet they often function as tools of control. This contradiction is the heart of their dark history. The system depends on people carrying debt, not paying it off. Banks earn more when balances linger. Late fees, interest, and penalties drive profits. This is not a flaw. It is the design. Understanding this history reveals a powerful lesson. Credit cards are not evil, but they are not neutral. They were built to profit from human behavior, especially stress, optimism, and delay. Knowing this changes how you use them. The future raises new questions. Digital wallets, buy now, pay later services, and invisible credit expand the same model in new forms. The names change, but the strategy remains. Make spending easy and repayment distant. The first takeaway is that credit cards were designed to shift financial risk onto individuals while preserving profits for institutions. Convenience came at a cost most people never see. The second takeaway is that economic stress fuels credit growth more than prosperity does. When wages stall, credit fills the gap, quietly transferring pressure to households. The third takeaway is that understanding the system restores power. Awareness does not eliminate debt, but it changes decisions and expectations. As credit evolves, the question is not whether cards will disappear, but whether consumers will finally see them clearly. History shows that financial tools reflect power, not just progress. If this story made you rethink your relationship with credit, share your thoughts below. Like the video, and subscribe for deeper economic investigations that reveal what headlines leave out. Meta Economy Lab gives you new perspective to see and understand more about the economy and related topics, so you can subscribe to the channel for continuous learning.